Real P&L trading show where I share my real P&L on 3 accounts and share my proprietary SafeWheel options trading system for free. And yes, I changed the name of my program to the Real P&L Trading Show. So if it sound a little bit different, it's a new name. All right, I want to make sure you guys can hear me okay. Please type in the chat that you can hear me. Let me know. Also, be sure to post any questions you might have. I want to make sure I get to all questions before the end of the broadcast. So I'm waiting to make sure that you guys can hear me okay before I kind of move forward here. And I think there's like a 5 or 7 second delay. Okay, yes. Okay, guys, thank you for letting me know you can hear me. All right, so next, first, I should say, I'm going into the Earnings Edge account here. You can see here, there's the Earnings Edge account. And last week I traded AMAT and made $895. So that was a nice, good win here. It says 919, so I probably broke even on it earlier in the year for $30 or whatever, or $20. So $895 win there. You can see my P&L, $8,265. You don't see net liquidation P&L anywhere else, or there might be a couple other places, but you haven't seen it anywhere since 2019 on a consistent basis. There's a lot of people that talk about how they share their P&L, or maybe they do or don't, but what happened during the crash of 2020, right? They for some reason they haven't shown it, since before then. Okay. So we were talking about the Earnings Edge. I had AMAT, $895 win. A record is, since I did my tweak in October of last year, 16 wins, 16 losses, 6 ties. So, 500%, 50% win rate. Average win, 1,030. Average loss, $641. So 2022, we know 63% versus 19. And what is the P&L? 8265. Let's put that in there. And let's look at the SPY. I can see it down here, 438.74. 438.74. All right, so we can see in 2022, vastly outperformed the S&P. This system is not outperforming this year. It's barely pretty much at break even. But if you look at since inception of 2022, up 65% versus the S&P, still down 7.5% since 2021. This thing has not recovered. Okay. So, and with the Earnings Edge, there is a lot of volatility too. So I'm not, it is vastly outperforming, but you got to live with the volatility. But it's a nice system. Okay. That is the Earnings Edge. Let's get to the Premier Level 5. Let's see what's going on with that. So the Premier Level 5 did quite well. It's been doing quite well. I had a win last week. Took one of the trades off. And let's see, 36,608 or 36,588. 36,588. That's a good week. This system right here, I've got 24 wins, 7 losses, 10 break evens, 3 open trades currently. You get about 1/4 the drawdown of the S&P 500. So you can multiply my number times 4 approximately, and it'll give you the risk-adjusted return. So I started on April 8th, 2022. So in 2022, did 12.2 versus minus 6.9. But really, you can kind of multiply that one almost times 4 to really get the risk-adjusted rate. So it's vastly outperforming. This year, 8.6 versus the S&P is up 14.72. So S&P is doing pretty well this year. But still, again, you can multiply that out, and the risk-adjusted returns are much better for the PL5. But when we look at the total since 2022, since April 8th, you can see that the PL5 is doing 22% overall, and the market is up 7.4%. So since April 8th. So still vastly outperforming, especially on a risk-adjusted basis on the Premier Level 5. I like that system. It only takes about 15 minutes a week to manage, and low drawdowns, and outperforms the S&P 500. Do you know that only about 1% of hedge funds outperform the S&P, and their average outperformance is only by 3% per year? Only 1% of hedge funds, the top 1%, outperform the S&P 500, according to an article. So if you can outperform the S&P 500, you're in the top 1%. Okay, so let's get into the Safe Wheel. Safe Wheel has a little more risk than the Premier Level 5, but only about approximately half the drawdowns of the S&P 500. So again, on a risk-adjusted basis, you can kind of multiply these numbers times 2, just on a ballpark. Let's see what we're doing. Where is my account? Right here on the Safe Wheel. Okay. So I'm trading with DKNG. Let's see, my account 6538. Safe Wheel 6538. So it's down a little bit, it looks like. Okay, we can see 2022 numbers vastly outperformed the S&P 500 here. Did 21% versus minus 19. This year, 7.5 versus 14.7. So about half the nominal return, but again, you multiply that by about 2 to get to your risk adjusted. So we're basically on par in 2023. But when you take the beginning of 2022 into present, which is about 2 years now, the Safe Wheel's up over 30%, where the S&P is down 7.5. So vastly outperforming, especially on a risk adjusted basis. Even if you add that, it's really outperforming there. Okay, so those are the numbers for the Safe Wheel with real P&L here. Okay, so what are we doing? Trading DKNG. I like DKNG. Okay, so I'm probably going to stick with it. So the first thing I do is I look at my put hedge and I manage it. And one of the questions I have is it under 100 days until expiration? And the answer is yes. So when it's under 100 days, that means I need to remove this put hedge or replace it. Or, at this point, I'm going to get a new put hedge. I'm going to not use this one anymore. I'm going to cash it out. And I don't own any shares of DKNG, right? Therefore, I could trade, or I could go into a different underlying if I choose to do so. I could look through these underlyings here on this list. If they fit the criteria, I could go with them, but I'm not going to because I like DKNG. DKNG is trading at around 35. That's okay. And I know it meets all the other criteria. So I'm going to stay with DKNG, but I do have the option right now to leave it, because whenever I move my put hedge and put on a new put hedge and I don't own shares, I can go into any underlying I want. So make sure you guys if you have any questions about that, let me know. So the first thing I'm going to do here is I'm going to get rid of this put hedge here, because I'm going to close it because it's depreciating too fast. So I'm going to create closing order and I'm going to close it out. Mid is 141. I want to get as much as I can for it. Let's look at the order. I'm working this order. 141. That's not filling. I'll just keep going until I get filled. Okay, so there's a fill there. Now I only have my long call. Okay, so if I decided to move underlyings, yeah, I would probably have to sell out this long call and I might lose a couple dollars on that, but that would be no big deal, right? So I do put these long calls on Fridays, but they're only $5. So if I wanted to move underlyings, I'd be okay with, getting out of this call. But I do have my long call set. Now I want to start over. Basically, I'm starting over right now. I have my long call already from last Friday. If I didn't, I would put on a new long call for $5 in the nearest expiration cycle. And also I'm going to put on my put hedge. So where am I going to put this thing? I'm going to put it to closest to 150 days. And I think I want to be at least above 130 days on this. I'd have to look at the actual exact rules. I want to make sure, but above 130 days, but closest to 150. So that's the first thing I want to do is determine what expiration cycle. So I make sure I'm in DK and G. Which expiration cycle am I going to use? Well, closest to 150 days, but above 130, that's the 186. Okay, so I know I'm going to buy my put hedge here in the 186 DTE, days until expiration. And which strike am I going to choose? I'm going to use one that's about 80% of the current price. So current price is, say, 34.9. I multiply that times 80% times 0.8. I get 27.92, which means I'm going to go with the $28 put. Okay, hopefully that makes sense. You guys can ask questions. I'm going to buy 3 of these. Why 3? Because I have between $5,000 and $10,000. Therefore, the sizing dictates that I do 3 put hedges and I do 1 call or put in the wheel. And if I do a second tier, then I would have the maximum of 2 of each. But I do 1 at a time. So anyways, 3 here. I want to pay as little as possible. And mid price 198 here. Oops. Let's see if I get this filled. I'll just keep working it until I get it filled. Might not fill there. Okay, so now that's filled. Now I have my put hedge in place. So I have my put hedge in place. I have my call in place. My long call. These are kind of the hedges of the system. Now I will run the traditional wheel. So I'm gonna, the way I like to do it, or the way that safe wheel, the way we do it, is we go into the nearest expiration cycle, which expires on Friday. Today's Monday. This is the one where we do the wheel. And I'm gonna sell a put because I'm opening up a new wheel position, and I want to get at least 35 cents, right? Because we're trading at $35 approximately. So I want to get about 35 cents minimum. And I want to be out of the money. Some stocks, if you try to get 35 cents, you won't be out of the money. So that's why you have to make sure you get a stock that you can buy or sell something out of the money for higher than 1% of the price of the underlying. So I could go with the 33, but not quite, not enough premium there. So I'm going to go with the next one that I can get, the 33.50. I'm going to sell the 33.50 put, and I'm going to do one of those. And I talked about sizing, and the bid is 44. Maybe I'll shoot for 45. Always try to get a little extra just in case, and then I'll just work it down. Hit cancel, replace, work it down. See, it not always, but a lot of times it moves, and it moved against me a little bit. Now the mid price is 42, so I'm kind of chasing it. It's kind of like it sees me coming, right? Okay. All right, here we are with the wheel with the short put, and then my hedge. I put hedge here, and then my long call, which hedges my hedge. So now my positions are on. And let's get to any questions. All right, so Victor. Hi, Carl. I have a question, maybe not specific to options, but I've heard some traders recently recommending going long the VIX. So what's your preference on this? Problem with the VIX is that it's kind of deceiving. It's kind of a weird. It's not like a stock. It always kind of reverts to the mean. It likes to go high it likes to spike high and then come back down and hang out down lower and kind of lives lower because of the way that it rolls. It's not really a normal instrument. And going along the VIX, you're really going to get a lot of depreciation. Anything you want to do, you want to back test it, but I would not have I don't currently don't have a system where you just go long the VIX because of the high depreciation of being long those calls. It's not like a normal underlying. Plus, going long calls or going long puts, that's a low probability trade. We know that because implied volatility is higher than realized volatility, even with the volatility, even with the options on the VIX itself. And Peter says futures, what ticker symbols? I'm not sure what you mean by that. Going long of yeah. So again, going long options is a low probability trade. I don't recommend that. All right, let's come down here. You guys hear me okay? Audio's working great. Charles says IV is high this week. Okay, I'm assuming you're talking about DKNG, and I did kind of notice that when I put on the trade. Yeah, look at the IV here this week compared to most weeks. It could be because it's coming off of earnings. Maybe it's a little volatile coming off of earnings. I'm not sure what the catalyst is for this higher IV than normal, but I'll take it and I'll sell premium against that. Okay. John Doe. I like that name. Since most of the trades are short term, how much do the taxes affect the returns trading with taxable account? I'm not an accountant. I definitely would talk to an accountant, but these are all going to be short term capital gains, right? So you're going to be paying the higher rate as far as I know. Right? That's typically what you do when you're trading. Unless you're doing the PL5, then you have the 1256 contract where you only pay short-term capital gains on 40% of your gains, and then 60% of your gains are long-term. Even though they happen within a year, you get that tax break with the PL5, but not with the safe wheel. You're going to be trading the short-term capital gains. Now, I'm not an accountant, so I don't know that much about taxes, so you definitely want to talk to an accountant. Tron. Last week I said my return on DKNG was 22%. I had a miscalculation. The return was 12%. Okay, well that's okay. 12% still pretty good, especially when you have approximately half the risk of owning the S&P 500 in terms of drawdowns. Tron says, I thought the rules were between 150 and 200 DTE. If Avery was here, she could give me the exact numbers on that. I could look those up, but I don't want to do that during a live stream. So maybe I'll make a comment in the, I'll pin a comment in this video to put that rule there to make sure that I did it correctly, but I believe it's above 130, but I'll double check that. I don't put hedges very often, so the rules themselves sometimes get a little gray, and I kind of go off of memory when I run the system because I developed it. Okay, Charles, can you show today's impact on margin for each of the positions? I think so. Let's see. So margin for each of the positions, so it's not really showing that. Here's my margin here. I would think it would show it individually, but it's not. It's only showing the total margin requirement of $550. Usually it kind of shows that on an individual basis. But hopefully that answers your question that it's $550 in margin. I wonder if there's somewhere else I can go. I don't think so. Yeah, usually it would show up here. Okay. All right. Anthony says, do you buy bonds with your excess capital for the safe wheel? No. Uh, you might be able to do that. Because I only have maybe $5,000 or $10,000. I don't really consider that, but you might be able to do something like that because I know you pay bonds. You get like 98, 99% of your buying power still, so you could technically buy bonds. But I like to keep I keep this pretty tight. Yeah, I use with this system. I use my margin pretty good. Like in the PL5, I really don't use a lot of the margin in there, but in this account, I'll be using that margin up. So I typically, when I buy bonds, I only use about 80% of my buying power to do it, just to keep things safe. So yeah, that wouldn't be a bad idea. Pick up a few more extra percentages, but I don't do it with the safe wheel. You probably could. I mean, I like the idea. James is talking to Victor. Options on the ES. Yeah, the PL5. We trade options on futures for the /ES. Will, can you go over the 4 market types and give what it takes for the markets to be classified what they are? For example, what percent of market has to rise to be rising bull? Maybe it could be a video. Well, it's just it depends on the time frame. If it's only a 1 month time frame, I mean, if you're up 2%, I'd probably call that a bull. But if you're up, 1% in a month, you're kind of pushing it. Maybe it's sideways. Bull market to me, 15% annualized, probably 12% annualized, even 8%. Maybe not annualized. That's a little cutting it close, but still maybe considered bull market. The sideways market, below maybe 8% in a year, below 5% annualized. Or if it's down 5 or 8%, maybe you're still kind of sideways. It's got to be pretty tight, maybe within 5%. And then your grind down market is just when the market goes down. I always divide things by monthly, right? Because I do this on a monthly basis. So if the market's down 2%, maybe 3% over a month period, I can call that a grind down, as long as the VIX doesn't spike significantly. Significantly for me, I like the VIX at around over 40. For me, is kind of like that's when you hit the crash scenario. The VIX hits 40, over 40, and you're going down. I would consider that a crash. That's kind of where I define it. 42, VIX of 42 is where I define a crash. So the market might be down 3 or 5 or 10%, and the VIX is above 42. I'm going to say that's more than likely a crash. You'll know because crashes happen. The market's just going crazy. Like you can't even catch it. I mean, it's just moving so much. You can kind of tell when it's crashing, as opposed to a grind down where the market's just going down. It's grinding, and it's coming down pretty hard. But maybe the VIX goes from maybe 15 to like 30. It's a pretty good move, but the market's kind of like not out of control, right? It's just grinding down compared to the crash where it's just all over the place, you know. So those are the way I kind of define it. It's not really a hard definition because I have to look at the time frames and then define it based on the time frame. Oh, good. Thanks, Avery. So it is 150 to 200 days. So even if it was at 130 or 120, that would be fine. So there's your answer. You were correct. 150 to 200. As far as where the put hedge DTE when you put it on. Victor, sorry, my question was sent earlier by mistake. It was split into 2 parts. I was trying to ask the preferred method of benefiting from a vol expansion without suffering too much of a loss from the contango event. I don't really have any systems. I haven't really developed anything or found anything that takes advantage of vol expansion. I just basically have found ways to take advantage of vol contraction and also have systems set up to take advantage of just normal vol situations. But as far as having something, well, let me take that back. My hedges, when they activate on my PL5, they are taking advantage of vol expansion, but they need to get the vol needs to expand significantly to activate those hedges. So I do have like that long tail uh, vol expansion ready to go, but it's got to be a pretty heavy expansion, like a crash scenario. So that's really my preferred method, is just to hold something that doesn't cost very much. It's very relatively cheap compared to my hedges are relatively cheap. That's the way I prefer to manage the vol expansion situations. I don't want to get into I wouldn't want to get into a system that talks about, the vol pops from 15 to 20 and I made money off of that. I've found that those types of systems are too expensive to maintain. Hopefully that answers your question, Victor. All right. So, Jason, new here. Okay. How you doing? You had a long call hedge to start. Is this why you stuck with DKNG? So the answer is no. That long call cost me like $5, and I will not make that the determining factor as to whether I stay with DKNG or not. If I felt like I wanted to move off of DKNG, I would have just sold that $5, maybe took a $5 loss and been okay with it. So that is not determining anything as far as which underlying I'm going to choose. And could I have otherwise chosen a different underlying? I could have chose a different underlying today, for sure. I don't, you haven't been with me, but when I originally started trading DKNG, it was losing money. I was down. And one of the reasons why I stuck with it was to prove that it doesn't matter what underlying I'm using as long as it fits the criteria. And so you can see here, P&L to date, $560. So you can see that DKNG has made money this year, but in the beginning of the year, or maybe late last year, it was actually losing money. So I kind of wanted to prove that it doesn't matter. Like, I'm not going to say that DKNG was losing me money, so I went away from it. It doesn't matter what underlying. This is a quantitative system. Victor. Yes, I meant that it would make money only in the extreme volatility expansions like market crashes. Yes, so I do have something for that on the PL5. And of course, I've got a nice hedge here also. Even in a grind down, the safe wheel is going to, remember we had a grind down recently and that hedge was really paying off. So grind downs, even with the safe wheel, the grind downs, this hedge pays off. But with the PL5, it needs a crash for the hedges to pay off. But yeah, I would recommend that if you hedge your portfolio, you do it with something that is relatively cheap compared to the premium that you're collecting. So playing around with the VIX, I haven't found anything that's relatively cheap going along the VIX. I haven't found anything that can do that. It's expensive when you play around with the VIX. That's what I have found. All right, David. Does the PL5 system have a similar roadmap to the safe wheel approach? Similar roadmap. No, I think it's much more simple. It just has about 6 questions that you ask, and it's either yes or no. And if it's yes, you do something, and if it's no, you don't do anything. Where the safe wheel kind of has the flow chart where it's like all these scenarios, and it seems the safe wheel to me seems a little more complicated as far as managing it. Now, as far as understanding why it works, how it works, the PL5 is more complicated with second order, third order Greeks and things like that. And the wheel's relatively simple in terms of, how does it work? It's pretty easy. You're selling puts, you're getting a sign, you're selling calls. That's pretty simple stuff. but the flow chart itself is pretty complicated compared to so the management seems to be a little more complicated with the safe wheel compared to the PO5. Okay, Jason. Jason says, not using your systems yet. What is the easiest way to get involved with you? I would trade the safe wheel. It depends on how much experience you have. If you understand a lot of the trade structures, the iron condors, the butterflies, you understand how they work. You have a good feel for them. You understand. You're a level 4 trader. You understand that it's time to sell premium to make money. But you found that you're not hedged. So you've been making money, selling premium, making money, and then all of a sudden you get blown out or you get hurt really bad because you've been trading all these trade structures, these traditional trade structures, and selling premium using those, and you realize that's not the best way to go. Then you're ready for the PL5. If you're just kind of getting into options and you're learning and you understand options a little bit, and you understand, what selling a call is, what buying a call is, I would go into the safe wheel because the safe wheel is relatively more simple to understand the concepts before you move on to the PL5. Also, the PL5, you start with $5,000 with with the safe wheel. You start with $5,000 with the PL5. You've got to have, I recommend you have at least $30,000. So there's another barrier there. So it's not just a little bit of knowledge, but it's also how much capital you have. Now, would I trade the safe wheel with 30 grand? You can, but I think once you get to $30,000, it's time to move over to the PL5, take less risk, get good returns. So if you have the capital, I would focus in on the PL5. But if you don't have a lot of experience, you can trade the safe wheel for a while, get a feel for options, and move on to the PL5. Anthony, is this system when selecting an underlying, is it best to choose an underlying that you expect to move higher or know where you might expect to move sideways, or does it even matter? So the system's based on not knowing what that stock is going to do. All my systems are based on non-directional. I do not know whether the stock's going to go up, down, or sideways. I just don't know. And I don't think anyone else knows on the short term. Maybe in the long term, it's probably going to go up because of inflation and all that kind of stuff. But you don't even know that either, honestly. Look what happened to Japan in 1989. I think that was the high. It still probably hasn't surpassed that high. So you just don't know the direction. And that's why I built the systems the way that I do. I built them to make it to where you don't have to know or you don't have to worry about it. So the system's non-directional. So I guess the answer is I don't choose an underlying based on what I think it's going to do. I fit it fits the criteria of fitting into the safe wheel criteria in terms of volatility, how much premium is available, other factors, and then I go with it. I don't know whether it's going to go up or down. Bill, found your channel this weekend. Where can I find these rules for the safe wheel? There's a link in the description if you want the fast track to the safe wheel. So we have the course, which is really well done course. Originally, it was just kind of like a flow chart and a couple things, but now it's really detailed, nice course. So if you want the fast track on all these rules and everything, you can go to the link in the description and get that, or you can watch all of my live streams. And within the live streams, you'll find all the rules, but you've got to go through all the live streams. That might take a little while, but you can get it for free if you want to take the time to do that. Or if you want to hurry up and get the results or figure it out really quick, then you can see the link in the description. Today's a good day to come in as a new person if you want to follow, because I basically opened up a new system. I started from scratch. So today, if you decided to start, if you were new or you wanted to start doing the safe wheel, today you would start over with me if you wanted to follow what I'm doing. This $40 call that I already owned, you can go in and buy that. today, and you'll be fine. And then you'll have the same positions that I have. I used to buy these on Mondays, these calls, but I do them on Fridays now. I like that protection over the weekend. Okay. I don't see any more questions. So I'm going to start to end the broadcast, but one thing I always like to say before I end, if the P&L is not real, what else are they trying to conceal? Okay, I'll be back next week. We'll see you then.